Edel. Well, that's an answer.
Thank
you. All right. Well, it is 1 o'clock, so let's go ahead and call the meeting to order. This is a special meeting of the City Council Finance Standing Subcommittee, which is composed of Mayor Pro Tem Garner and myself. The Mayor Pro Tem is unable to join us today due to illness. But we will proceed with the meeting. I will make note that this meeting is being recorded. Pursuant to Assembly Bill 361, this meeting will be conducted by teleconference and there will be no in-person public access at the meeting location. To join this meeting, please use the link that has been provided by the city clerk and is out. Public comments can also be submitted to the city clerk at cityclerk@palmspringsca.gov. First item on the agenda is public comment. Notices given that pursuant to the Brown Act, public comment is limited only to those items that appear on the notice and the agenda of the special meeting. Do we have any public comment?
We do. Kim Floyd is available for public comment.
All right. Kim, would you like to proceed?
Yes, thank you. Good afternoon and Happy New Year's. My name is Kim Floyd. I represent the Sierra Club as a local activist. I live in Palm Desert. The Sierra Club submitted written comments for today's agenda. I'll just briefly make a couple of enforcing comments. We are asking, one, that Palm Springs add to the city's investment policy specific investment restrictions concerning fossil fuel companies and banks that finance pipelines and fossil fuel infrastructure. And two, we're asking Palm Springs to make a formal request to CalPERS to divest from fossil fuel companies and banks that finance pipelines and fossil fuel businesses. Thank you for the time to speak, and I hope you have a chance to review the comments that we submitted.
Mr. Floyd, thank you. And while we don't usually comment back, I will tell you that we did receive it. I have had an opportunity to read your comments. This is a presentation and discussion committee meeting. There will be no action that will be taken during the course of this meeting beyond hearing the report and an opportunity for myself and any member of staff to ask questions of the presenters. So with that, are there any other public comments that we have today?
There are none.
Okay, then we will move on. Public comment will be closed and we will move on to item number 2, which is a presentation by Chandler Asset Management of the quarterly review of our city investments. Nancy, would you like to start with this?
Oh, I will introduce Mia and Chris will be giving us an update on our presentation and update on our investments. Ready, Chris?
I am ready to go. And I just wanted to, first of all, just confirm, Nancy, looking about 20-30 minutes to kind of go through the eco and then as well as the review the city's portfolio.
Yes, please.
Okay, perfect. So I'm going to share my screen right now. And just want to confirm that everyone is able to see this and see my screen. Perfect. So as I mentioned and talked with Nancy, first what I'd like to do is just give a little bit of brief economic commentary and then as well go through the city's account as well as provide a summary of the portfolio holdings as well. So first off, the economic commentary. I thought it's interesting because the last time that we had met presented to this committee was back in early October. And back then, when we talk about the themes of the economy, one of the things that we were looking at back then is to continue to get a little bit more clarity on returning to the level of economic activity we saw pre-pandemic. Now, as we look at the market right now and we move into the beginning of 2022, we're continuing to see market volatility, especially with the increase of the Omicron variant and how the impacts that we could see from that relative to some supply chain disruptions with regards to the continued pricing pressures that we've seen as well. However, overall, what we continue to look at from an economic perspective is that growth is continually going to be, it's moderate a little bit, but will continue to be above trend. So in a sense, we're moving continually in a positive direction for economic growth, economic activity. There is still some of that uncertainty, especially related to the pricing pressures. We believe we are at peak pricing pressures right now, and we'll start to see those alleviate a little bit. But what's interesting in this environment, you know, so goes the virus, so goes the economy. And as we look to see the impacts from the Omicron variant, could definitely impact the overall economic picture. But what's interesting is that the impact on economic activity seems to lessen with each new wave of the virus that comes through. Now, one of the things that we have seen that's definitely going to be a theme of 22 is the Fed and the Fed Open Market Committee, as they have increased their tapering. And now there's an expectation we could see 3 rate rises from the Fed in 2022. And I'll talk about that a little bit. But generally, as we look at the economy, we continue to move in that positive direction. There's still definitely going to be some volatility as we continue to move back to pre-pandemic levels. Now, one area that continues to be strong, moving in that positive direction, is the employment picture. We'll actually be getting an employment number this week, this Friday, for the month of December. November's numbers came in a little bit under expectations, where payrolls only increased by 210,000 comparatively to consensus of around 550,000. But as we look at the overall picture itself, the unemployment rate is about 4.2%. Now, this Friday, we're expecting around 422,000 of new jobs from the non-farm payrolls. But what's interesting right now, it seems to be this conversation around what I'm going to term the Great Resignation. Because what we saw in the month of October is actually, in the month of November, 4.5 million people quit their jobs in November. Okay. But what's interesting, though, is they didn't leave the labor force. They didn't leave the workforce. In a sense, what they did is they migrated to new jobs. Now, we still have about 10.6 million job openings in November. We still have a participation rate relative to the overall population that's below pre-pandemic levels. But due to the environment that we're in, we're seeing individuals quit their jobs. A large part of that, 6% of those were in hospitality. So it's a large area. We're seeing, again, this interesting dynamic that exists in the labor force right now. But it is still, we're still seeing some positive numbers relative to the overall employment numbers. What's interesting, though, as well, is the impact that's driving those individuals to quit and go over to new jobs, or in a sense, that Great Resignation, is coming from a strong wage growth. So what we've seen is that wage growth has increased, or the average hourly earnings has increased by about 4.8%. Now, that definitely has driven some of the impacts relative to inflation. So one of the biggest themes that we saw in the fourth quarter of 2021 was pricing pressures. As you can see, the CPI, that chart in the upper left-hand corner, increased by 6.8% in November, going up from 6.2% in October, definitely driven by gains in energy, food, cars, vehicles, and rent. I know everyone can actually see this. I find it interesting right now. If you go up to fill up your car, your automobile right now, a tank of gas has increased significantly. Those have been driven especially from the pricing pressures that we saw related to some of those supply chain disruptions as well. Even PCE, which is the metric that the Fed follows, increased in the month of November, where we saw PCE up 5.7% and core was up 4.7%, definitely above the Fed's target of 2%. Now, due to these upward pressures we saw from inflation, the Fed has reacted, where the Fed has increased the tapering of their asset purchases, and I'll talk a little bit more about this, but also have given them the platform that if we do see persistent pricing pressures continue into 2022, the Fed could be able to take action with regards to rate rises. So that's one of the things we're looking at right now. We believe we've actually met or are at peak pricing pressures, and we'll start to see some of those alleviate as we move into the late spring and summer of 2022. But again, it's something to monitor and it's something to continue to look at. If those pricing pressures persist, what activity we could definitely see from the Fed. One of the drivers from those pricing pressures has been the consumer, has been you and me going out, purchasing goods, going out to restaurants as such. Now, what we did see though is that the numbers for retail sales came in a little bit less than expected in November comparatively to October, even though they were still up over 18% on a year-over-year basis. What this is indicative of is the fact that it looks like the consumer got out ahead of these pricing pressures and went and started their holiday shopping season earlier this year. So we saw a lot of that holiday activity in October. I know personally, I started doing my holiday shopping in October, not wanting to wait till November or even December, which is what I usually consistently did historically. But what we've seen again is these trends that we see from the consumer coming out of the reopenings we saw about 9 months ago. Individuals started moving towards purchasing services versus goods. Now, as we came into the fall, we did see a little bit of a detraction from the purchasing of services. And even now, there is news of uptick due to the virus. We have seen some restaurant numbers relative to restaurant cancellations have started to increase. Airline flight trips being canceled. So just impacts from the virus could definitely impact the consumer. Why we look at the consumer itself is because 70% of our GDP comes from consumption, comes from you and I going out purchasing goods and services for the overall economy. But due to the immense demand that still exists in the overall market itself, it's still helping push growth as we move into the first half of 2022. Now, economic activity, as you can see here with the LAI and the Chicago Fed National Activity Index, both of these numbers are suggesting that we are still in moderate trend growth projections, but that the first half numbers definitely could be impacted by the resurgence of the virus, as well as the impacts from some of those supply chains. The numbers are both showing that we're continuing to move in those positive directions. But again, it's one of the things as we look out into the guidance that they have provided, both of these formats for 2022, it's just that we could see increased risks posed to the resurgence of the virus and those ongoing headwinds related to the supply chain disruptions. One area, though, of high economic or leading economic indicators that continues to be a strength and a bulwark throughout the entire 2020, during the entire pandemic, has actually been housing. Now, we did see housing starts decrease a little bit as we came into the beginning of the fall, and I would attribute those to the supply chain disruptions as well as some challenges relative to material costs. But those have now come back. As you can see, housing starts jumped in November, up 11.8%. What I find interesting, though, is that conversation around home prices. Home prices were up, as you can see here, 19% in September. For the month of October, they were up 18.4%. And a lot of that is contributed to that conversation we're all familiar with, the lack of supply. The tight supply is definitely constraining prices. I actually went and took a look at the average home listing in Palm Springs. Right now in the month of December was actually at 895,000, and that's up from the month of November about 735,000. So what we've seen is a large increase, especially in pricing pressures, even in your neighborhoods as well, is continue to attribute to those increases, especially the lack of supply and the increased demand that still exists, still in this low interest rate environment. But one of the good signs is as the challenges we're starting to see, we saw from the ISM manufacturing numbers today, some of the challenges that some of the sectors started to experience from some of the supply chain disruptions are starting to alleviate themselves. And you can see that by that housing starts number that increased in the month of November. Now, as we look at manufacturing, as I just indicated, the ISM numbers came in today for manufacturing. What we did see is that ISM number declined. As noted in this production of this report, we saw the ISM for November at 61.1. For the month of December, that declined to 58.7. So it declined a little bit, but what's interesting is we actually look at the data. The data was actually positive. It declined a little bit based off of output, but we saw positive numbers relative to a decrease in capacity constraints. And what that means is that for the manufacturers, a lot of the challenges that they've seen over the past couple of months related to supply chain issues, material costs, even labor challenges are starting to alleviate themselves a bit. And again, that's a definite positive momentum as we move into 2022 for that continued moderate growth that we're looking and expecting into the first half of 22. Now, GDP numbers, as you can see here, came in for the third quarter at 2.3%. We don't have the numbers for the fourth quarter yet, but we're looking at around 6% for GDP for the fourth quarter and looking at around 4% for GDP for Q1 of 2022, and a total output of 2022 estimating around 3.9% for GDP for the entire year. Still above trend of the average 2% that we saw over the previous years pre-pandemic. And one thing I would like to point out, you'll definitely see the impact that the consumer has on GDP with that line, the first line in the columns in the upper left-hand corner, with the impact that we saw from the Delta variant constraining growth in the third quarter, definitely from the personal consumption expenditures. But as we kind of came out of that and moved into the rest of the year, the definite output that we saw in those positive numbers that I even referenced already from the consumer in the fourth quarter, bringing our GDP up strong and historic for 2021. Now, I want to spend a little bit of time just quickly on the Fed before I move on to the city's portfolio. As I mentioned, I think this is going to be a strong theme for 2022. The Fed recently came out at the end of 2021 and started the tapering of their asset purchases. Okay. So what the Fed has been doing, and you'll notice here by this chart in the upper left-hand corner, the Fed has actually been making purchases of $120 billion a month of treasuries and agency-backed securities in response to the pandemic to be able to help support the economy. This is consistent with the programs that they had set up in place coming out of the 2008-2009 Great Recession. And you can see the Fed's balance sheet increased, almost touching $9 trillion as of the end of December. In November, they announced at the beginning of the tapering or the lowering of those asset purchases by $15 billion a month. Well, the Fed then came out in December and said, due to the unexpected consistent pricing pressures that we're seeing, the Fed has, in a sense, expedited the tapering of their asset purchases, where they're now purchasing or lowering those purchases by $30 billion a month, with the expectation now that they're going to complete the tapering of their asset purchases by the spring, possibly by March or April, instead of waiting to the midsummer to do so. Why has the Fed done that? The Fed did that to be able to give them a larger leeway in case they need to raise the federal funds rate in response to these consistent pricing pressures that we've seen. The Fed now has given us an indication that we could see 3 rate rises from the Fed in 2022. Now, the first one, kind of more expecting in early summer, is when we could see that. But the good thing is that the Fed is actually going to be data dependent. The expectations for rate hikes are definitely as a backdrop to continued strong economic growth. And the Fed is definitely going to give themselves an opportunity to pivot if all of a sudden we see pricing pressures alleviate quicker than expected, or vice versa if the pricing pressures are a little bit more persistent than expected. So the good thing with the Fed is one of the key points that they want to consistently make for the market is providing forward guidance. They do not want to cause any surprises to the market so that we could actually see some drastic movements in rates in response to that. But the market and the Fed has indicated they believe we could see 3 rate rises from the Fed, more towards the summer and then going towards the second half of 2022, but all data dependent and dependent on the continued economic improvement that we see. We move in that continued positive direction from a labor perspective, as well as a continued growth perspective and alleviation of some of those pricing pressures. But it is definitely an expectation and belief we are coming off of this zero bound rate in scenario that we've been in for the past couple of years this year. And so that's one of the things we'll definitely look at. And finally, bond yields. So with the roller coaster we went through in 2021, you can see that definitely represented by movements in interest rates in that chart in the upper left-hand corner. The 10-year Treasury note indicated the solid green, the 5-year note in the dotted gray, and in dotted magenta lines by the 2-year note. Earlier in the year, we saw interest rates increase, and then due to the Delta variant, they flattened off until later in the year, we did see again interest rates start to increase, in a sense, the steepening of the yield curve. What we have seen is that the short end of the yield curve is still anchored by Fed and Fed policy at that zero bound rate. But however, what we have seen is the yield curve has steepened due to continued inflation and growth expectations we have seen from the overall market itself. And you'll notice the difference between where the yield curve is. First off, that solid green line is November of 21. comparatively to that dotted magenta line where we saw a year ago, but also the steepening of the curve that we've seen from August of 21 into November of 21. We have seen rates steepen, and we do expect that there's still an opportunity for rates to continue to steepen as we move into the first half of 2022. One thing to keep in mind with this is the fact that bonds and the bonds that the city holds their value has an inverse relationship to the movement of interest rates. So when interest rates go up, the value of bonds go down. When interest rates go down, the value of bonds go up. Two things with that. One, you will see a depreciation in the value of the bonds that the city holds. But secondarily, that also gives us an opportunity to be able to invest in higher interest rates along the yield curve for the city. And as we've actually been working with staff to be very tactical as we actually bring the city's portfolio out to our target direction and target duration, we're being very methodical about that, but being able to take advantage of yields in this longer end of the yield curve and around that 4 to 5 year mark. So overall, as we look at the economic picture, unfortunately, the impacts of the virus are continuing to impact that economic picture. Although as we seize these new strains, they're not having as big of an economic impact as the original strains have had relative to the overall economic outlook. We continue to move, but getting back closer to those pre-pandemic levels for all the economic factors. And one of the big themes for 2022 is going to be the Fed and watching the Fed as they adjust their policy from being very accommodative to a little bit more tightening. So any questions on any economic areas that I covered or didn't cover you'd like me to go into more detail on before I go over the city's portfolio? Okay.
Go ahead. Are there any questions from anyone on staff regarding what's been presented to us so far?
No questions here.
Okay. Chris, this is very good information. I would ask that a copy of your slides be made available to all of us as well as posted to our website so that they're available to the public.
Mayor Middleton, I'll be sure to send a copy of that report to Nancy following the conclusion of this presentation.
Okay. Thank you very much. I'll defer any questions I have until after the next presentation.
Perfect. So let's go through the city's portfolio. So first off, we want to make sure we review the investment objectives is to provide safety of principal, ensure preservation of capital, making sure we're providing added liquidity to meet all of the requirements. And third, a commensurate rate of return, making sure we're honoring the tenets, not only of the investment policy, but also making sure we're investing in a social responsible manner. The Chandler Asset Met, the performance objective is based off of a benchmark, a market index of a 1 to 5 year US Treasury Agency index. And the strategy is to make sure we achieve these objectives, making sure we're investing high quality fixed income securities consistent with the investment policy, as well as focusing on the social responsible investment, as well as with California government code. This page, I believe, and the next page are actually two of the most important pages of the entire presentation. What this shows is that the city's portfolio is in compliance with the city's investment policy, as well as with California government code. And now let's look at the characteristics of the city's portfolio. So first off, I'm going to focus on that center column where it shows the city's portfolio as of November 30th. We can see the average maturity is 1.37 years. Our modified duration is 1.31. The purchase yield is 0.47%. The market yield is 0.40%. Average credit quality AA+, and a total market value of $146.6 million. A couple of key points. You'll notice the increase in market value from 8/31 to 11/30. That's due to deposits that were made in working with staff from liquidity accounts into the city's core portfolio during that time period. And I would also like to point out, due to that fact, we did get a large deposit that came in on 11/30. So that's why and I'll show you in the next slide why the money market value increased, but that also affected some of the other numbers we see here. Another point I want to point out, the purchase yield. So you'll notice our purchase yield is 0.47% compared to the market yield of 0.40. If we went out and purchased all the securities on 11/30 that the city currently has in their portfolio, the yield we would get would be 0.40%. But instead, we've got a purchase yield of 0.47%, which is higher than the market yield. Secondarily and third, the last thing I want to mention is that we are continually building out the portfolio, bringing it to that duration of the benchmark. So you'll notice the benchmark duration, which is that 1 to 5 year ICE-BAML U.S. Treasury Agency Index, is around 2.5 years. The portfolio is around 1.31 years. As we continue to work with staff and bringing the portfolio with additional deposits, as well as managing the portfolio with our recommendations to staff, we will continue bringing the portfolio in a very methodical, deliberate way to the portfolio duration, not just rushing all at once to bring that portfolio at that time period. And I think the portfolio has benefited from that, especially in a rising rate environment. Now, the sector distribution, as you'll notice here, I'm going to focus on that chart on the left-hand side, that donut here. You can see the U.S. Treasury allocation is just under 43%. Pardon me, our agency allocation is just under 31%. The corporate allocation, just over 11%. That money market fund, as I indicated, that deposit that came in on 11/30 did see a big increase in that money market fund. And those funds have already been deployed in the month of December, but this report is as of November 30th. And so that has come back down to 1%. Supranational at 3.4%, as well as the asset-backed securities just under 1%, negotiable CDs 1.5%. Here are all the issuers for the city's portfolio. As you can see here, the majority of the city's positions is in U.S. government debt or in debt with the implied backing of the United States government. And with the majority, a very well-diversified portfolio, with our goal is to make sure we keep all of those corporate allocations below 2.5%. It's a very well-diversified portfolio, and at this time, we do not have any concerns about any of the positions in the portfolio. But are there any questions about any of the issuers?
I would like to go back one slide, Chris, if we could. All right. The sector distribution that we have right now, this is the actual distribution, or is this the target distribution that we have?
This is as of November 30th, this is the actual distribution for the portfolio that Chandler is managing.
All right. And how does that compare to targets?
I would say this is in line with general overall targets. I think it's interesting in this environment, especially in the environment that we saw in November 30th, the adjustments relative to based off of spreads and the spread environment, okay, about what would be more appropriate. We still see a very, very tight spread level. But as we're building out the portfolio, what we would want to do is make sure we are allocating towards sectors that we believe are going to provide those appropriate spread levels, in addition to making sure we're meeting the mandates set forth by social responsible investing for the city's portfolio. I would expect that in other, I would say, more mature portfolios, you possibly would see a corporate allocation closer to 20 to 25%. And maybe an asset-backed allocation that might be closer to 3 to 4%, as well as a supranational allocation that would be a little bit higher than that as well. Also, I would indicate too that the Treasury allocation might be a little bit higher than possibly some other areas if you look at more mature portfolios, but that's because in 2021, what we actually saw is that you were not getting compensated for going out for taking that additional risk in some other sectors, specifically like agency bonds. So therefore, that allocation to agencies decreased. And I would expect that until we actually start to see some issuance from Fannie and Freddie and some other agencies, that allocation continue to dwindle and the Treasury allocation might continue to stay as stable where it's at right now.
Right. Talk to me a little bit more about the agency allocation, what is in that part of the portfolio, and how those percentages of 30.9% would compare to best practices among other municipalities that you are working with.
Sure. So I'm going to jump ahead a little bit so we can actually talk specifically about those. So if we look right here for the agency bonds, okay, what you can see here are federal home loan banks, agency debt from Fannie and Freddie that have the implied backing of the United States government. So they're very highly rated, as you can see here, with AAA ratings or high ratings by S&P, Moody's, and or Fitch. One of the challenges with agency bonds, especially over the past year, is the fact that agency debt was actually trading through
Mhm.
or having yields lower than US Treasuries. So in a sense, they were more expensive because there's not a lot of supply. I would expect that agency allocation to continue to dwindle as we move into 2022, unless we actually see some issuance that comes forth from the Federal Home Loan Bank, from the Federal Home Loan Association, as well as the other associations, Fannie, Freddie, as such. Now, relative, it's challenging sometimes to compare to other public agencies. I would think that that's in line, that 30 to 40%, I think is in line with some other cities, especially of your size. What I would say though, it's interesting because when we look at the portfolio, duration is the most important key, and then sector allocation is the second area. And what we do on a monthly basis is reallocate to look at what different sectors could be most appropriate based off of spread levels and risk tolerance levels. In 2020, towards the end of 2020, agency bonds were very attractive because they were providing a spread of about +6 to +8 above treasuries, okay? And then all of a sudden that stopped, okay? And so that's why that agency allocation has continued to dwindle. And I would not expect that to increase significantly unless we see new issuance, because there's no reason to pay those high prices for those bonds for the city if you're not getting that interest rate compensation.
I follow that and I agree. The corporate allocation of 11.1%. Did I hear you say that you've seen that in other municipalities as high as 25%?
Yeah, so for per California government code, public agencies are permitted to have corporate allocations of medium-term notes up to 30%.
Right.
Now, I believe corporate allocations, especially making sure we're honoring those tenets of safety and liquidity, generally we have seen 20 to 25% as a allocation or a sleeve in a city's portfolio. Again, due to the spread levels that existed. Now, corporate bonds, we've seen spread levels in the corporate allocation be very tight over the past year, especially the amount of issuance. Now, we are expecting, especially as we've turned over the calendar year, to start to see some new issuance that will come through for corporate allocations. However, that corporate allocation of 20 to 25% are for cities that do not have some of the same focus that the city of Palm Springs has with regards to making sure we're investing in social responsible investing. And so due to that fact, I don't think we'll possibly get to that level of 20 or 25% for a corporate allocation unless we continue to see attractive opportunities in the market and we bring them to staff. But that's, I would say that's where we're at, is most cities, I would say that we work with 20 to 25%.
All right. Are these bonds or equities or a mix?
Oh, no, these are all bonds. There is no, per California Government Code 53601, per the city's investment policy, we are only allowed to purchase high quality fixed income securities. So especially the corporate bonds or the corporate allocation is simply corporate debt. And there are no equities in any of the city's portfolio.
All right. Thank you.
Thank you. Those are great questions. Thank you. And then moving forward, as we talked about the issuers, and now as we can see here, the quality distribution, this is based off of S&P. So you can see here that just under 75% of the portfolio is AA rated by S&P. We do see a couple positions that are non-rated. That's most likely the negotiable CDs and the asset-backed security that is not rated by S&P, but is rated by Moody's and or Fitch. So therefore it is compliance with the city's investment policy. If this rating source was actually based off of Moody's and or Fitch, you would see the majority of this being AAA. The reason why it's a majority 75% AA is because S&P still has the United States government at AA rated. And here you can see the duration distribution, in a sense, the term structure of the portfolio. Now, a large majority of that, especially in that 0 to 0.25% range, is due to that recent deposit we did see at the end of November. But we can also see the diversification comparatively to the 1 to 5 year benchmark, as we do look to make sure we're maintaining that liquidity for the city's portfolio, but also taking advantage of that steepness of the yield curve with some of those purchases in around that 3 to 4 and 4 to 5 year mark as we continue to build out the portfolio. And I think as we look at this, the yield curve continue to steepen, that's one of the areas where we actually look to add some opportunities for the city and the city's portfolio in around that 3 to 4 year range and that 4 to 5 year range as well.
Very good.
And as you can see, here's the comparison between the durations of where we were back in August to November. And as I mentioned before, you can see that increase in that 3 to 4 year range and highlighting around that 4 to 5 year range as well. And now the investment performance. So as you can see, for the last 3 months, the city's portfolio had a return of minus 0.3%, comparatively the benchmark at minus 0.69%. And then since inception, which is 3/31/21, the portfolio is down to minus 0.2% compared to the benchmark at minus 0.3%. Now, first off, this is a total return. So what this is representative of is the depreciation in the value of the bonds that the city holds as we've seen interest rates increase. However, at the same time, though, the city is still maintaining and receiving income for the bonds that the city holds. And as we do reinvestments, making sure we're increasing that income over time. So as we move into a year, we're hoping to start to see these numbers start to improve over time.
And Chris, if we can we go back to the characteristics to show the city what their current yield is? Because I do believe they're comfortable or more familiar with yield, and I'd love for you to compare that to what they'd be getting currently in CalTrust and or LAIF.
Yeah, Mia, that's a great point. So right now the yield for the city's portfolio is 47 basis points. And as we look at, and I can actually jump to the showing what the yield right now is for the reporting report. That was actually the next slide. So you can see here for the other positions that the city maintains in LAIF as well as in CalTrust, the yield on that is 47 basis points. So our portfolio having a yield of 30 basis points greater than those liquidity components. LAIF right now is providing a yield of about 21 basis points. So again, some of the challenges that exist, especially in this low rate environment for some of those vehicles. And you can see here's the allocation between LAIF as well as with the local government investment pool. You'll notice a big change between these two. We actually worked with staff and made a recommendation that due to the environment that we're in right now, and with the fact that LAIF was earning a yield substantially higher than what the CalTrust portfolio was, we made a recommendation to actually move more assets into LAIF than keeping it in CalTrust. And staff actually took that recommendation, and we made that change to moving some more assets in LAIF comparatively to the CalTrust pool.
What is the actual difference between those returns?
So LAIF right now is returning 21 basis points. CalTrust is 13 basis points. Mayor Melton, the other reason for that is LAIF does provide dollar for dollar liquidity for the city. CalTrust, however, provides a floating NAV. And so one of our recommendations was that due to a rising interest rate environment, it would behoove the city to actually take advantage of that dollar for dollar withdrawal component that LAIF has. Whereas if you left money in the CalTrust component, you actually could possibly receive a little bit less than its total in there because of that floating NAV. It's not dollar for dollar. And that's why that was another component to our recommendation.
Fair enough. Okay.
And as you can see here, here's the allocations between the two. And then finally, the consolidated information. So for the total the city's total portfolio, we can see the average maturity around 0.74 years, that duration 0.71 years, our total purchase yield of 0.34%, average market yield of 0.3%, average credit quality AA+, and the total market value is just under 270 million. And here again is the consolidated breakdown between the two. The donut, you'll notice again, the big differences and changes between the amount that's in the local government investment pool CalTrust compared to the LAIF as they increased during that time period, as well as the difference in the money market fund. But again, 23% in Treasury, 16%, just under 70% in agencies, 6% in corporates, and 1.8% in supranationals.
And that amount that is in corporate, again, it's corporate bonds. How are we making decisions as to where to make investments? What's the criteria that goes into determining what bonds you're bringing into the portfolio?
So first off, that criteria is following a initial screening and approval list that we have worked with staff. So we had already back in April gone through a due diligence process and making recommendations to provide a list of corporate bonds that actually fall inside the guidance of social responsible investing. If and when, due to working with staff, we will make our recommendations to allocate assets that come into the portfolio. We look again to make sure we're maintaining safety and liquidity as those components. We then secondarily look at the sectors, which would be the most appropriate sectors, whether it's treasuries, agencies, supernaturals, corporates, as we discussed. If we then believe corporate allocations is going to benefit, we then go through that list. And we do have issuers that meet that requirement and are on the list to our recommendations. We provide that recommendation to staff.
So are these specific investments? I've decided to invest in ABC corporate bonds, or are you operating off of, and I'm going to have to use an equity term, some type of index?
I'm sorry, I didn't catch that last term. I apologize.
That's okay. Are you making specific investments in specific corporations?
Yes. So as you can see here, what we have here is the holdings report. So you'll notice here that here are all the corporate bonds that the city owns. As you can see, the number one bond here is Apple. And again, this is showing you have an Apple bond of $2 million. You also see an investment in Microsoft. I would notice Charles Schwab, Amazon, as well as you can see here all the other positions. So they're actually individual corporate bonds into entities such as John Deere as such.
And all of these fall within what is defined as socially responsible. So could you give us a definition of what socially responsible means, what that includes, what that excludes?
Sure. So first off, I'll just review the process that we went through first off with staff to put this list together. Staff had come to us and said, look, we are looking to be able to provide a investment policy and investment program that focuses on social responsible investing. Now, social responsible investing and environmental social governance are the two vernaculars that are used to be able to, invest from that social responsible process. What we had done is we went through and followed the four largest social responsible / ESG investment vehicles, the Calvert Large Cap Growth Core Responsible Index, the US All Cap Choice Total Return Index, the Vanguard Social Index Fund, as well as the iShares ESG Awareness MSCI USA ETF Fund. What we did is we cross-referenced all four of those funds to look at what companies or corporations are listed on all four funds. Okay. Once we have put that list together, we provided it to staff to review to make sure if they were comfortable with all of the positions that were part of that list. And as I'm looking at, there's about a list of about 30 bonds that are part, or 30 corporations, I apologize, that meet that requirements. Now, the requirements set forth about why they were part of each individual fund is different and pertaining to each individual fund from a social guidance and governance perspective. When we look at social guidance, environmental social governance, it's there promoting those specific goals relative to environmental, social governance, and social responsible investing. When we look at it from a SRI component, that is restricting specific investments. So I know specifically we had initially talked about making sure that we are not investing in any alcohol, tobacco funds or any manufacturer of alcohol, tobacco, as well as any entities that distribute firearms, such as Walmart, example. So we went through and working with staff to make sure that those were scrubbed and removed from the list as well.
Thank you.
I think it's important to note too that as an overlay, this language is included in the city's investment policy, as well as a management directive that Nancy and her staff signed off on. And then each transaction is subject to approval. So before Chris and Jason go in and transact on the city's behalf, we share our recommendations with Nancy, and then she provides us with final approval to go ahead and purchase bonds into the city's portfolio. So there are several layers of protection.
I really appreciate you walking through some of the process here, because these are terms that get used very commonly, but I think are very frequently misunderstood in terms of what they mean in terms of actual practice. The socially responsible investment program that the city of Palm Springs has, would you describe that as consistent with a large number of your municipal clients, or are we a outlier in our approach to investing?
So I think I'm going to answer that in two folds. Mayor Milton. First, I believe you are an outlier relative to the management of the city's funds, incorporating that other layer of risk management, that other layer of focusing on social responsible investing. With regards to those clients that we work with that incorporate social responsible investing, I think the process is in line and is consistent with best practices that we've seen from other public agencies that have decided to adopt the social responsible investing as a part of their investment program. And I would actually commend the city for the process that's been established. And not only for, I think what's also important is the review of it on an annual basis. We had set this up back in April, 9 months ago. And I think just like the requirement to review the investment policy on an annual basis, reviewing the process that the social responsible parameters that have been put forth should be reviewed on an annual basis as well.
Great, thank you.
And I do not have any other questions, or sorry, I do not have anything else for my presentation, unless there are any other questions regarding the holdings for the city's portfolio or any of the transactions that occurred over the past 3 months.
Nancy, Justin, do you have any additional questions or comments that you would like to make?
I do not.
I do not. I meet with them either weekly or bi-weekly and review the portfolio with them. We spend about an hour together each week and just make sure everything's on target.
All right. Well, I want to thank you on behalf of the city and the city council for an excellent presentation. I look forward to having the slides available, and we will look forward to the very next meeting that we have an opportunity to hear from you. And if there is no other business before the committee, the meeting is adjourned, and thank you, and everybody please stay safe.
Thank you, everyone. Take care. Stay safe.
All right, thank you.